Thanks for joining us. I have to admit, I don't feel super great. It's gonna take everything I have to get through this presentation. But so if I don't like shake your hand later, I'm not being rude. I just don't want you to get ill or anything like that. Okay? But I do think I can talk to this microphone for like 30-ish some minutes. We are running off of like super old school PowerPoint. I'm not even gonna bring up like the presentation and the fun, like I'm just gonna click through it, so bear with me. If you have questions, go ahead, feel free. I'll try to answer as discreetly as possible. I'm missing one slide, so I'm gonna do it verbally. The one slide is, you cannot use this presentation against me when you're fighting your IRS audit, okay? I'm gonna talk through things that I know are laws. I'm gonna talk through a few things that are probably gray areas that not every IRS agent may agree with. So you can't sue me or use this presentation against me in your own financial and tax woes. Is that fair? Unless you employ me, and that's a whole different story altogether, okay? My name is Ryan, I work at GBE. I'm the president of that firm. We're in Seward, Nebraska. We also have an investment wing. I also teach some classes at Concordia in Seward. And I also own rentals. My rentals are actually interesting. They're in Kearney, Nebraska, if you know where that is. I have 2 different fourplexes because my friend's father is a professor at UNK, so we have access to many college students who are looking to rent, and then if they trash the place, he will fail them. So it's like a great system, okay? A couple duplexes there, and then I'm working on our first storage unit property. I have not done this before. I'm terrified, mostly because construction's going on 1.5 years and it's not done yet. But other than that, we're getting that going as well. So, I do live it, as well as know some things about taxes. So, those are my jobs. This is also my other job. Boy, we're way cuter in real life. Okay, these are my kiddos. And then for some reason I decided, like I was just feeling very, I don't know, like showing off baby photos. They're actually 10, 7, and 4 now. Pictures from when they're 4, 2, and newborn. But super cute face, so like I'm a real person, not just a robot, I guess is what that shows, okay? But you're here for more than that. I want to get into some basics, and you'll be like, wow, this is really basic, Ryan. Like, I'm not an idiot, and I'm not here to like put you down, but this is talking about real estate. I want to get into the taxes. I'm going to get super deep, like probably we're all going to be a little uncomfortable. But just as a reminder, trying to make real estate into a great investment, some things that have worked for me, some things that have worked for people that I partner with, just some general concepts that you want to think about in terms of rental real estate, okay? So if you're able to purchase a rental somewhere between the 1% rule and the 15% rule, if you're able to take that fair market value, that purchase price, 1% of the total, rent that out per month, okay? That would equal 12%, or 15% of the fair market value, divide that by 12, whatever. If you can rent it between 12 and 15% in total in a year of what you bought it for, you're probably doing pretty good. That was probably a good investment for you, for example. And some of you are like, wow, I rented out for way more than that, so you're killing it, I'm guessing, or you bought it super cheap and you know how to fix it up, or you just know markets better than I do, okay? If you can get the mortgage rate flexed out at 5% or less, you are no longer in the year 2022. I have no idea what a current rate is. I'm guessing you would have to get, does anyone know rates? Is it 7%? 7? Eeks, okay? So, at 7%, watch yourself, okay? You're going to have to rent it for more, or put more down, or buy it for cheaper to make that thing a go, okay? At 3.25%, even an idiot could make money. Not that you're dumb, okay? But a lot of people can make money at that rate. Things have changed dramatically. Can you hold it for 7 years or more while someone is paying off the equity for it before you flip it or exchange it? We'll get into some of those concepts in a little bit. Is it a great investment as a flip? Generally speaking, I don't do flips. I'm terrified of them. I'm pretty sure I would be. I just know I would suck at them, okay? But some of you are great. Some of you understand flip markets. Can you hold it for over a year before you flip? Sometimes you can't because the money's too good, okay? If you can, and it's an investment for you, you're getting long-term capital gains. I assume you know that means better than short-term capital gains. I'm not sure you know how to quantify that, but just so you know, if you can get long-term capital gains, your federal top end is going to cap probably at 15%. Right? In some cases, could be 0% depending on your situation. I don't have time for everyone's individual situation. You're going to be capped at 15. Whereas if it's short-term capital gain, you're capped at whatever your current ordinary tax rate is. So at least 22% federal, probably maybe higher. Okay. So holding it out for a year to get that long-term rate could be very valuable for you at that point in time, okay? If you were in the business of flipping, then those long-term capital gains do not apply to you because now you have to pay ordinary tax and self-employment tax, and that's a whole other presentation. I'm not gonna do that tonight, okay? Okay? But if you're doing a flip as an investment, try to stretch it out over a year, lock in that long-term capital gains rate. You won't maybe know exactly what that means. Just tell your accountant, and they'll be like, good job. Like, yay, you saved taxes. Good on you, okay? All right. This is my thing about real estate. Everyone's like, I'm going to buy real estate to save on taxes. And then I laugh, right? You're probably not gonna save a lot of taxes. Generally not. Generally there are limitations. Generally it's considered passive. Generally you can't write off below zero. Generally you cannot use it to offset other type of income. All of these limitations apply to you, okay? Plus, generally you have to call some of it land, some of it building, and stretch it out over many years. It's just not, as a standalone, not a great write-off, okay? When you're buying real estate, residential or commercial, that's sitting on a lot, right? It's not an elevated condo in California. I assume it's in Nebraska. Maybe it's not, okay? Some of it has to go to land that you cannot take a write-off for, period, end of story, okay? Or you could cheat and try to do that. I don't recommend that, okay? And then the portions that you're calling for, the actual structure itself, if it's a residential property, it's 27 and a half years that you write that over, or if it's commercial, that's 39 years of a write-off. Not like, I bought it, I wrote it off today. No, that's not true, okay? That's not true. And there's special rules called cost segs. We'll get into that in a second as well, okay? So, your fancy friends told you to do a cost segregation study, which I'm not against them, okay? I'm not against cost segs. Does everyone know what a cost seg is? Have you seen a cost seg? Raise your hand. 1, 2, 3. Maybe I should just stop right there. You're like, cost segs, not for you. Moving on, okay? So, if you really get deep into real estate, like really deep, okay? Like commercial property deep, I could see a cost seg being beneficial to you. What does a cost segregation study do? It finds ways to peel out parts of that purchase that you can depreciate much faster, like super fast, okay? Like hyper fast. Let's see here. Okay, so some of it still has to go to land, which you can't write off. Some of it still has to go to the building structure, which you can't take front end or bonus depreciation on. You have to spread it out over time. 27 and a half years residential, 39 for commercial. But then this fancy schmancy cost segregation, which I brought a copy of, but maybe we can look at it a little bit later, does two more things. It splits out building components and site improvements. Big deal. Not a joke, actually a very big deal. It finds these items which we consider 5-year property, things flooring, lighting, interior windows, carpet, things of that nature, which you can take a write-off in 1 year, and assigns a value to them, and then places that value inside of a report that you hand to the IRS, and they go, you can't write this off, and go, here's my study, and they go, have a great day, thank you, right? Because it's like a 90-page report backed by guidance that you can use to take a one-time write-off, and then in addition to that, it says, here are your site improvements for the same property. Think driveway, curbs, sidewalks, landscaping, which we call 15-year property. Like, oh, that's a long time to write it off. Except for under current laws, 15-year property can also be written off in 1 year, okay? And splits those out for you so you can take immediate write-off on those items, okay? Which, if you're buying one residential real estate property to rent, not super helpful, okay? It's like a $5,000 study and it saved you probably 12 bucks, okay? However, as you are compiling these assets over time, or the purchase is, what's a good number? $500,000 bucks? $1 million bucks or more? Okay, now it may be worth it to get into this area or partner with someone who knows what they're doing to take those write-offs faster, faster, faster. Okay? Do we have any questions on cost segregation? Yes, sir.
Do you just do it when you first buy the property?
That's a great question. Do you just do it when you first, I don't even cover this. Do you just do it when you first buy the property? Amazing question. The answer is typically yes. The sub-answer is you are allowed to do one in the future and go back and fix how you screwed up depreciation the first year you bought it. So if you bought it in 2019 and you realize in 2022 you screwed up and could have done better, you can get a new cost segregation study, pay a fancy accountant a lot of money, they can fix that mistake and do it all in your current tax year so you get those faster write-offs, okay? But you would only want to do that if that's going to save you a bunch of money. This is going to cost a lot, and the accountant's probably not going to go cheap on you either, okay? Typically, year of purchase. Typically, year of purchase. Other question?
Is that easier to do if you built the unit from ground up? So you
Is
have
it-
all of the invoices from the segregated?
This is a really good question that I probably won't have an answer for. Is it easier to do if you're the one who's building it from ground up so you know all the inputs? I would think yes, but frankly, I don't do cost segregation studies, so we'd have to ask a company, and I bet they're gonna charge you regardless. Be like, thanks for that helpful info. Here's your $5,000 invoice. Either way, yes. I would think that would be helpful. What it might allow you to do is do your own, kind of assemble your own study without paying someone to do it if you trust your numbers. Great question. Aaron?
I don't know if you were going to say this later on, but is it better to do splitting it into 4 ways to depreciate versus just the 2?
Is it better to split it into 4 ways than just the 2?
If you're not going to do a cost segregation.
If you're not going to do a cost segregation study,
Still take that.
it is still beneficial to you to find a dollar amount to assign the 4 ways, okay? You're just not backed by an IRS approved report, okay? So, I think what Aaron's essentially asking, which I'll answer this way, could you and I team up on a purchase of 1 rental property and decide what the driveways were valued at and decide the carpeting and flooring without paying someone to do the study for us on our 1 rental? And is it valuable to do that? Yes, we can do that, and yes, I think it would be valuable. Yes. Yes. Question?
So bonus depreciation is supposed to start going down over the next.
Oh, I'm gonna get to that.
Oh, my bad.
Or, no, keep going, we'll ask it, just in case I forget, but yeah.
So next year it goes down to 80%, so is this part of, and then the year after that 60 and 40. So is that part of the cost segregation where you're only, as of this year, you're allowed to do 100% in year 1, but moving forward, you're only allowed to do 80% year 1 next year?
Yes, all of this is true. Super smart guy over there says he doesn't do taxes, but he knows that bonus is fading out, okay? So you must know a lot about taxes. So, I am going to get to that a little bit, but to answer, does that make a cost seg in 2022 more valuable than 23 and 24, where you can't fully bonus? I don't think so, because you can still 179, and I'll talk about that. Okay? Great question. Any other questions? I knew this was going to be a smart group, so I'm about to take this high end. Okay? Started with some basics so we could all warm up together. Okay? Who knows what QIP is? Qualified Improvement Property. Who knows what that means? No idea. First of all, it doesn't exist with residential. Okay? So this is a concept for commercial properties only. Okay? It says, you've already built this out. You bought it, you built it out. However, you decide you want to make it better on the inside to permanent structures, and there is a way to call that property 15-year instead of 39 and take the write-off all in 1 year instead of spreading it out over the next 4 decades. Okay? That's what QIP is. You'll know what when you see it, you know what it is, right? You're like, oh, I had this building and I rented it out to a pizza company, but they left. So now I'm gutting all the walls and building it out for offices for a dental company. Like, that's QIP, okay? That's what it is. And there's a way to that, oh, now I have to wait 39 years to write that off. No, that's QIP. It's 15-year property, we can take it in one shot under current laws, okay? Not a law that, no such thing for residential. There is no QIP for residential property, okay? Why is that important? All of this is helping us take losses. As you can see, our friend Drake here handing us an L. Did you get my joke, young people? Okay. Took me like an hour to come up with that joke. All right, real estate, considered passive. Everyone who thinks they're buying it for a write-off, I think is confused, okay? We're a little confused, except for the exceptions, okay? So, we cannot take a deduction. So when people tell me, I just retired, or I quit my job, I hate working, also I cashed out my 401k, also I bought a bunch of rentals. So I cashed out my 401k for $200,000 and I bought $200,000 of rentals. Here you go, accountant, like, get me to zero. That's not actually how this works, okay? You will pay tax on the $200,000 you cashed out. You will save $0 on the rentals you bought because you cannot go below zero, okay? But I lost all that money. It's all in the properties. I didn't do a loan. Great. That is not how this works, okay? There's land. There's amounts we have to spread out over the next 27 years. And even the amounts that we do cost seg for 5 and 15 year, that took you to minus 100 grand, we have to carry those because you cannot go below zero, except for a few certain exceptions. Do you know what these are? You do not. Or maybe you do, okay? I cannot go below zero, which means I cannot offset other income, wages, retirement, anything. I cannot go below zero in a tax year unless one of these applies, okay? I can use it to offset other rental income that I have from my other profitable properties, okay? So if you're starting to stack profitable properties, that might be a time where you buy the $1 million property, do the cost seg, take the write-off to offset the other 180 grand of rental income that you're generating from your other properties. That might make sense, okay? If you're an active participant in your rental property, as defined by owning at least 10% of it and helping manage it, whatever that means, that's what the IRS says, not me, okay? You can take up to a $25,000 loss on said rental property in a given tax year. However, once your gross income goes above $100,000, that loss number starts phasing out. Once you're above 150, you can take a loss of 0, right? Well, I just put a bunch of money into this property. It's brand new. It had interest, insurance, repairs. I lost like 37 grand. We did a cost seg, right? And I go, great, you lost $37,000 on it. It will save you 0 actual dollars in taxes this year because your other income is above $150,000. But I did all these things. It does not matter. Those losses carry forward into the future to offset future passive profits, or if you sell the property, get a capture them all in one shot. That's how that law works, okay? So people who tell me they buy real estate for the write-offs, first I laugh, and then we talk about what the actual law is, okay? Other ways to lose on real estate and have it actually save you on taxes is to be a real estate tax professional, as defined by 50% or more of my personal services for the year are in real property. 750 hours minimum of service during the year in real property. Who are my defined real estate tax pros? Anyone else? Okay. Now, you don't have these limits. You can start taking L's all over the place. Cost segregation studies become very important to you because you can lose money and actually save yourself on taxes. It's incredible, okay? The rest of us cannot do that. I do taxes. I am subject to the active participant and passive law rules. If I happen to lose money, I have to carry it over. It saves me no actual taxes that year. Have I made that clear? Is there questions on that rule? Why don't I just become a real estate tax professional? Because it takes 750 hours per year. And over half of what you do for a living has to be in that realm. So the ones I work with, that's actually all they do all year. Or they're like a realtor, for example. Okay? Questions? Questions?
So is the 100 grand, can that be on your W-2 income too? So if you work somewhere, but you also have rentals, and they lose, let's say 25 grand, do you now pay income tax on 75 grand?
So,
Or am I thinking of that?
nope, you were thinking of it right. If your rentals lost 25 grand and your wages at work were 100 grand or less, and you have no other income, you still get to take a $25,000 loss that year. If the rental lost 50 grand, you get to take a $25,000 loss that year. So it's capped on the top end with 25 grand, and then your gross income has to be below that level for you to be able to take the write-off. Okay? Good question. Another one.
If you qualify as a real estate professional, are you allowed to take L's against your, in my case, wife's W-2 income?
So the question is, I'm a real estate professional, my spouse is not, we file jointly, are my losses helping me save taxes off of their income? And the answer is yes, right? So if you look at a 1040, which I should have brought, but I'm not very smart, you see that wages and rental losses are all lined up together. And those all add up to be your adjusted gross income. So if your negative is lowering your adjusted gross income, you're offsetting her or any other income that you have, you're lowering your taxes on that. Yes, that is true. Question?
Is that a $25,000 loss, is that deducted from your taxable income, or is that actual dollars?
This is a great question. This is a question I really want everyone to understand, because I get excited about losses and then I forget to quantify them, okay? So it's not like the $25,000 saved me 25,000 literal dollars back to me in a refund. No, it saved me $25,000 against my tax rate. And you can see at those levels, probably 12% federal, 5% state. So if I lost 10 grand and I'm below 100 grand AGI, probably saved me $1,800 in actual taxes that year. It'd be much better to make $1 million on your rentals, pay 250 grand in taxes, and keep the 750 grand, for example, than losing $10,000 and it saves you 1,800 bucks in taxes, for example, okay? But yes, It saves you in taxes, but only at your tax rate. Or as I like to say, you can't spend your way into making money. Well, not in this case. There's other ways you can, but not in this case. Okay? Good. Other questions? Okay. If I lost you before, I'm definitely going to lose you now. Okay? I will definitely lose you now. I'm not even sure we should read this. How do I summarize this shortly? Let's do a show of hands. This will make me feel better. Who's heard of the election for real property trade or business ever before tonight? None of us? Oh, good. I can explain it. A super high level tax concept to you in a bar in Lincoln, Nebraska on a rainy night.
Over here.
I'm really excited for this. Can you tell? The reason I'm bringing this up, this isn't even a new rule. It's just that no one's cared before because bonus depreciation and just depreciation in general was an add back when calculating whether you can write off your interest on your property or not. Okay? So people were losing money on rentals and still deducting the interest on the property, the mortgage interest. However, starting right about now, that rule has become a little more serious because depreciation is no longer an add back to the calculation as to how much interest from your property that you can write off. So, thinking of it in another way, with our little example that I wrote, you're limited on how much interest you can write off. It's limited to business interest plus 30% of your taxable income on the property. So, for example, if you had $100,000 of taxable income from property or properties, and then you had $40,000 of mortgage interest, you were only able to write off $30,000 of that mortgage interest this year because depreciation was a number that got you to that $100,000 number, which was an add back to the calculation before, but that's gone now. It doesn't exist anymore. That phased out. Okay? So it means you're maxing out how much interest you can write off on your properties, which has a whole bunch of different ramifications for your tax situation, for which the government said, oh, that's going to be painful for many of you. We should make a law that says you can elect out of that stupid rule that we just created. So here's how we do that. We can say that we are a real property trade or business, and now that interest rule goes away. Everyone's like, oh, great, why don't I just do that? And they're like, oh, if you do that, you can't ever go backwards, and if you do that, the property life that you're using for the main structure must be extended out. It's no longer 27 and a half years, it's 30 years. It's no longer 39 years, it's 40 years. Oh, and if you were planning on doing QIP for your commercial property and writing that off in 1 year, you can't do that either. So they made little sacrifices in order for you to continue to write off all of the interest from your property, okay? So what you should be is super confused right now. And what you should also be is thinking, how am I gonna do this on my taxes? And when I do, am I gonna go to jail? Or is anyone gonna be paying attention? So the first question you should actually ask, is anyone gonna be paying attention? And the answer is no. Like your chances of being audited, we all know, are almost nothing, right? Okay, let's just be honest, okay? I'm not advocating for bad tax policy, I'm just being honest with you, okay? So the realization is, you can do about whatever you want, no one will notice. However, my job is to tell you what the law is, and then let you figure it out from there, okay? So I've done a little research. Here's what I came up with. If you have a concern, if your rentals are not profitable enough to be able to be a 30% of that number is higher than your interest. I'm going to tell you that the right way. Then you be profitable enough that 30% of that number is a number above what your mortgage interest is on that same property. Okay? So, if that's not a concern for you because you don't have a mortgage on the property, then you can ignore the rest of this, go have a drink. Okay? If you have lending on your properties, now we need to start using our brains, unfortunately. Okay? And so now writing off the interest becomes a concern, and you go, okay, I want to be able to write off that interest. I have to elect to be real property trade or business. And what am I sacrificing? On residential property, very little. You're sacrificing very little. You're sacrificing 2.5 years on the building structure. And by that I mean you're depreciating it over 30 years instead of 27.5. And to everyone in this room, that's basically the same number. Okay? Right? It's 3 decades regardless. Okay? So, on residential property, if interest write-off is a concern for you, tell you or your TurboTax or your CPA professional that yes, I want to be real property trade or business. So I can get my interest write-off without significant concerns because I am leveraged on that property, that residential property. Okay? I know you have questions, don't ask them. Okay? We're gonna go over this a couple of times. Any commercial real estate owners here? Do I even need to spend time on this? Ugh. Okay, it's more confusing for commercial because of QIP. If you are planning, if interest is a concern for you, but you're also planning on doing improvements to the property that you would have been able to write off in 1 year, and now you elect real property trade or business, cool, you got the interest write-off. Now you have to take that QIP over 20 years. You can't do the one-time write-off. That's, oof. And then you go, Ryan, what would you do? I have no idea. I'm not sure what I would do in that situation. Super complex, ton of math behind that, okay? As long as you don't have qualified improvements of hundreds of thousands of dollars on your commercial property coming up, you elect real property trade or business, you get your interest deduction, and you're sacrificing 1 year on that building. You're going from 39 to 40 years of depreciation life. You're sacrificing almost nothing. Unless you were gonna do hundreds of thousands of QIP, then you're sacrificing that. Instead of 1 year deduction, it's gotta go over 20 years, okay? And since there's so few of you, I'm not gonna cover that again, but I will quiz you, okay? Questions?
I think an easy question. So you said that you can't go back. So do you have to look at your crystal ball and know if you're going to invest in commercial property in the future when you make the selection?
Yes, you have to know, you cannot go back. Per property election, you cannot go backwards. Now, I say that, and then the government, this rule actually has been in place since 2018. You just had no idea because we weren't talking about it because nobody cared, because that limitation didn't exist because depreciation was not actually lowering how much interest you could write off. Nobody cared, okay? And then they go, oh wow, people didn't care, but we're changing the rule. So now they've allowed you to make an adjustment to that election one time, even if you already owned it, and it's this year, okay? But you have to have your crystal ball to know, I'm gonna make improvements to that property. I need to decide what I'm doing. I need to do it right now. Because I doubt they'll let that happen again. 3 years from now, you're ready to do 200 grand to that property, and they'll say, no, you cannot go back. You cannot re-elect. You cannot go backwards, okay? So, you do have one chance to do it now. One chance to fix it all. It's this year, and I don't think they're gonna let people fix that once they do it, okay? Once you make that election, it's for that property for life, okay? Question?
Oh, I was just gonna say, so that's per property, not per taxpayer.
Right. So the question is that per property or per taxpayer? I knew someone was going to ask that. I knew it was going to be you, Josh. My limited research would say it's per property. Okay? So if there's an IRS agent here that knows that's wrong, please tell us all now. Okay? I'm pretty sure it's per property. I'm almost certain it's per property. Okay?
And that's the same for residential? real
Yes,
estate
same for
trader?
residential and commercial. Yes. Unless you lump all of your properties together when you're doing one bookkeeping or one accounting for everything, and then there's no way to split out the properties, and then you're selecting one for everything you do. Okay? Most of the people I work with split it out per property, so it's pretty easy to decipher what's going on. Okay?
Do
Question?
you like that for property on Schedule E, or do you file a separate form for that?
It's a great question. It's a box on Schedule E, but then I like to, just to make no confusion, have an additional election, which is tagged on to the very end of the tax return. Lucky for me, I have software that does it, so I click a box, and yay, it just does it for me, and I look super smart. Okay? Yes, I like to do both. The box on the E, and then the election behind the very end of the tax return. Great question. Other questions? All right. That was super high end. See how I like started basic and then went super high end on you? Here's a quiz. Like, I have no idea what this idiot is saying. Start paying attention right now, okay? I'm an active participant in residential real estate, but not a real estate professional. I have no other passive income or loss. I make over 150K from other sources. My rentals will net $0 after depreciation for the next coming years. This will limit my mortgage interest expense deduction. Okay, those are all facts. True or false, I should elect RPTOB to harness those additional interest expenses. You could be right. I hear trues and falses. It's a really fun question because you could be right either way. If you know why you're saying it. If you know why you're saying it, you could be right either way. Does anyone have the guts to tell the group?
True because of the income?
True, because now you will be able to make sure that interest expense deduction is locked in to your taxes. False, because you're not actually going to be able to write it off this year or any of the future years because of the other exceptions to the rules that we already talked about. Okay? So I would answer it this way. True, do it, lock in the losses. It won't actually save you taxes yet until you have more passive income or you sell the property. Okay? But to sacrifice so true or false, if I elect it, there's no downside for me. False, the downside is what? 2.5 years on the building. Almost nothing. I'm sacrificing almost nothing. Oh, and then I have to actually do my taxes the right way. So you can make this election and then not set up depreciation the right way, and then you still screwed up. That's bad. Don't do that. Okay? Okay? So true, but it doesn't actually help you till that property starts making money, or other properties start making money, or you sell it. Is that fair? Okay. I'm an active participant in commercial property, and I'm a real estate professional, and I make over $150,000 a year, and my rentals will net $0. This will limit my mortgage interest. True or false, I should elect real property trader business to harness the additional interest expenses. True, except for what am I giving up? 1 year on the building, or 20 years if I have QIP. If I'm gonna make internal improvements to that property of significant dollar amounts, I'm giving that up. I won't be able to take the one-time write-off. I'm giving that up, okay? That's your downside, is QIP. Well, that and not doing your taxes right, okay? I still have no idea what you just said, Ryan, and now I'm really tired and I just want to drink. Okay. I'm an active participant in residential real estate. My rentals have no financing. I bought them all straight up. with daddy's cash, or mom's, whatever, okay? True or false, I should elect real property trader business?
False.
False, it's getting you nowhere. It's getting you absolutely nothing because there is no interest to write off. It's not helping you at all. Plus there's many ways you'll screw up your taxes after that, okay? That was easy. I'm glad you woke up for that one, okay? Do we want to go over real property trader business, or do we just want to move on with our lives? Let's just move on, okay. By the way, it is a thing you're gonna have to figure out on your taxes in about 2.5 months, 3 months, depending on when you file, okay? So it's a significant thing. I think I made my point. Pay attention so somebody does something the right way for you, okay? If you do your own taxes, God bless you. Like, good luck. Good luck to you. I'm proud of you, okay? 1031 exchanges. Who wants a refresher on this? This is where I save a bunch of money by not paying taxes when I sell my property, which is true if you do these things. Identify the next property within 45 days. Close on the next property within 180 days. Do not take a check payment when you sell said property. I've seen this a lot. Yeah, I'm 1031ing it. Also, I've got 400 grand in my bank account. Oops, I just ruined the 1031. All I had to do was tell the title company to hold it for me, which they would have done for a small fee until I buy the new property, okay? Here's the one that everyone messes up. Hopefully you're smarter than this. All right, I sold my property for 500 grand. I bought it a few years ago for 400 grand. I'm sitting on 100 grand capital gain. I don't want to pay any taxes on that. So I got to reinvest 100 grand. Nope. I got to reinvest like at least 400 grand. Nope. Nope. You will pay 100% tax on that gain. You must reinvest the full amount that you sold it for to defer the full amount of the gain. If you sold it for 500 grand, you've got to buy the next one for 500 grand. Okay? If you sold it for 500 grand, you buy the next one for 450, well, it's probably prorated, right? Nope. You saved 50 grand in taxes, is all. 50 grand in capital gains, actually, not 50 grand in taxes. 50 grand in gains. You've got to reinvest all of it or more to defer 100% of that gain. I see it all the time. It's scary. It is super scary. Well, I reinvested over half of it. You should only have to pay tax on half the gains. That's not the math the IRS does. You will pay tax on all the gains, and then you'll have a new property that you didn't even want. Okay? If you're going to do it the right way, go all the way and invest all of that into the next property. Is that clear? Please don't do that thing. Please don't do it and then bring it to your tax professional in March and be like, fix this. Like, I can't. Okay? I also want you to be aware that a mortgage can be paid off on the sale of a 1031, which is called boot, which normally triggers a gain. But if you have an assumption of a new mortgage that much or more to go with your purchase of that much or more, you can still defer that gain. I don't know if that resonates or makes sense to people, okay? Typically, receiving money or having a mortgage paid off triggers a gain. There is a rule that says you can still avoid that, invest that much or more, assume that much or more of a new mortgage into a new property, you still get gain deferral. Yes?
Along with the 1031, have you ever used or familiar with the IRS code 453 monetized installment sale program, which allows you to take all of the gains deferred for 30 years?
I have heard of installment sales, but they're normally like in-house buyer and sellers. So I don't know anything about, are you talking about someone pays them off over time, like it's seller financed?
No.
Nope. Okay.
You should talk to them.
Okay. You are smarter than I am, and I do not know what a 453 is, but I can't wait to Google it tonight.
It's like reading stereo instructions. It was a part of the original IRS code back in about 1913.
What do you have to do to complete, to get deferral of the tax?
Talk to me.
Okay, sounds good.
I don't do it, but I have the right people.
Okay, sounds good. But then, yeah, I didn't even talk about, you just brought up installment sales. Oh my gosh, I didn't even talk about that tonight. We're not ready for that. We'll do that next year, okay? By the way, this is not the same thing as selling your primary residence. So be a friend. Be a friend who doesn't let their friend believe they're about to sell their primary residence and have a whole bunch of taxes unless they reinvest it into a new house, okay? My clients are super, positive people, mostly smart. I get this question 50 times, 100 times a year. I just sold my house, oh man. How much capital gains do I have? I bought it for 100 grand 20 years ago, and I just sold it for 250, no gains. On a primary residence, if you've lived there 2 of the last 5 years, that's 250 grand of capital, not of sale, of capital gain per person, tax-free, don't have to reinvest it, don't have to redirect it, don't have to buy that much of a house or more, it's just yours, you can take it straight to the casino, or the bank. I mean, either one, right? Either way. It's yours. It's fine. But he sold it for $1 million, but you bought it for 900 grand. That's a $100,000 capital gain. You lived there more than 2 years, we're done. So don't call me, don't email me, it's over, okay? It's over. So be a friend and tell your friends, this is not the same as a 1031 exchange. This is your primary residence under Code Section 121, the Internal Revenue Code. Different laws, okay?
I have a question.
Yeah.
Investment property that is your permanent residence.
How is it both? I don't know if I want to go too much. Investment property that is your personal residence, I don't know if I want to listen to the next part. Are we violating some time? Are we violating some time? See me after. Let's have a private conversation about that. Typically, you can't have both. I'm not sure how you could have both. If you're renting out your basement to a
You're
friend
renting
or
it to
whatever.
yourself.
Are you renting it to your business?
No, your business is renting it to you.
So many violations of law potentially going on there. Is it necessary for your business? Would they have provided it to any employee? Just they're providing it to you because you happen to be the owner of the business? Would you have bought that same house and rented it out to this guy who's your employee who you don't actually know? It sounds like you maybe wouldn't. That's very questionable. Seems like it's business at that point and not a primary residence. Seems like you'd have to pay tax on a sale. But we can chat about that later. Question?
Is there a cap of $400,000, $500,000 on the 121?
Is there a cap on the 121 sale amount or capital?
Gains amount.
The capital gains amount, there is a cap, it's 250 grand per person.
500,000.
500,000 if you're married filing joint, yes.
Then you get it. And that's what I'm talking about comes into effect.
Okay, yeah. So then, if you're about to sell it for a $375,000 gain and you're single, just get married before December 31st. You can separate the next year, it's fine. No, you really can't. That wasn't a joke. I don't know why we're laughing. Okay, it's kind of funny. All right, this is what this smart guy was talking about. I'm not sure if you're ready for this. Whatever, it's a law. Right now you can buy things and just, if they're 5-year or 15-year property, it's called bonus. You get 100% of it as a write-off. You don't even have to turn your brain on, it's just done, except for this law is phasing out, right? And so then next year you do the same cost seg study and you can only write off 80% of your 5 and 15-year property, and then 60%, and then 40%, and then 20%. And then in the year 2027 and beyond, you can write off 0% of that the first year. However, you are still allowed to use 179 depreciation in place of bonus. As a taxpayer, what you should think to yourself is, there is no difference, okay? Why they made 2 of them, I don't know. Why you can do both, one of them still, I don't know. I didn't make these laws. You can't make this stuff up. 179 still would allow you to write off the 5 and 15-year property in 1 year. There are different limitations with 179 depreciation. I don't want to make it sound like it's the exact same, but for your purposes, it really kind of is. You can take the write-off You just can't go below 0. If you take it as 179, you can't amend it in a future year and take less. That's a restriction. If you've ever had to amend your returns, what a pain. That is a super pain in the butt. But other than those few things, you still can cost saving, you can still write it off in 1 year, okay? Unless they change the 179 laws, which currently they have not. Currently they have not, okay? So it feels like you're losing something here, and then there's another law right in behind it that says, no, go ahead, just take it. Just write it off. We don't actually care, okay? The 179 has some restrictions, but for your purposes, let's just pretend they're not that great, okay? Does that make sense or help for you? Yeah?
I do have a kind of follow-up.
Please.
to that. So if you qualify as a real estate professional and you can go below 0, as of the 170, with the 179, you would not be able to go below that, correct?
That is the way the law is currently written, correct. So whereas bonus could take you negative as a real estate tax pro, the 179 would not let you as a real estate tax pro. So that does become harmful if you're looking at negative numbers.
Okay.
Yes. But maybe they change that and they give it to you, who knows? All right. So if you're about to bonus for losses, like now, you have 19 days to do it. Get out there, buy that property and get your cost seg done. No problem. Oh, I forgot I did this. Oh yeah, energy credits. Do you know they exist? Okay. Solar electric, solar water heater, geothermal, wind energy. For the next 10 years, you get 30% of the cost of that, plus labor for installation, as a credit. And by credit, like, so Aaron reminded us, oh, the $25,000 loss is based on your tax rate. A credit is a credit. Like, if I paid $100,000 for solar, that's $30,000 right off my tax return. Not a deduction, like a credit, like money, like actual cash money. So, like, those are big numbers. And I'm not telling you to do something you don't want to do. I'm just saying if you do it, let's just save a truckload of taxes doing energy efficient stuff, right? Makes sense. And then there's other like ones that used to have a lifetime limit of $500 that magically are getting increased. So like windows, doors, insulation, metal roofs, skylights, you can get $1,200 a year. It's like 10% of the cost, $1,200 a year for the next 10 years. It used to be 10% of the cost, and then once you hit $500 in a lifetime, you were just done. But they've reset all those rules. So windows, doors, insulation, metal roof, skylights, heating, air, those things are now available for new credits in 2023, so don't pay that bill for 20 more days. Then you'll get a super big credit for it in 23, whereas in 2022, you might have already been lifetime capped out, for example, on those. Question?
Is this for personal residence and investments?
Oh yeah, both. Yes. This is for residential though, specifically, okay? Unless you can find a way to do, well, you could do solar on commercial. The energy efficient home improvements are residential. Primary residence or investment property, yes. And then the big energy credits is just for like real estate. It's like anything you want to do. So if you're doing it for investment purposes or your own primary residence, these credits are wide open for you. Pretty sweet. Pretty sweet. Question?
Credit is not refundable?
So, yeah, I think they kept that the same. So the comment is the credit is non-refundable. So I said it was $30,000 in cash, which it is, but not if you have $30,000 in taxes. If you have $30,000 in taxes, then you're just gonna get the money straight up. If you don't, it uses it against your taxes until and it carries over until it's gone. So if you have 10 grand in taxes you normally have, then you'll get it over each of the next 3 years. Yes, it's non-refundable. Yes, my apologies. It won't be straight cash right away. You actually have to pay some taxes to get it. So annoying. You have to make some money. Okay? Good. Other questions? Also, I can't believe I forgot this slide. This is so bad. We live in Nebraska. Who owns real estate in Nebraska? Oh, you do? Oh, good for you. You found the right group. Are you doing your Nebraska property tax credit against your state income taxes? Were you, and follow me if you're like, what is this? Pay attention now. This is your one chance, okay? Like you had to look up the county that you're in. It's got a code number. It's alphabetical. Seward is code 80. The parcel number and the amount of school property taxes that you paid on that parcel, and you recorded it to the state income taxes, and then you got a credit that showed up on line whatever that is, 36, and it reduced your income taxes in Nebraska. Yes?
Yes.
Okay. If you're lost, you're doing it wrong, okay? Find someone to help you. You're missing out on a ton of money. Probably, essentially 12.5% of your real estate taxes are coming back to you in the form of a credit in Nebraska. So like, do this. Plus they're upping it this year for community colleges, and it's going up to like 30%. It's gonna be mind-blowing, okay?
Is it just for this year?
Is PTC
Expires at some point, right?
Oh, this is great. Should we get into like how government works and like legislation? This is not set to expire anytime soon. No, it started out as like a 6% credit, and it was like, I don't know how much you want to know, but it was like this little pet toy of Governor Ricketts and State Senator Luann Linehan, who I both appreciate, okay? But they're like, oh, this is fun. And they're like, what if we make the credit bigger if the state collects more dollars? And then like corn and grain prices went boom, and the state had hordes of money, and the calculation took it to 25% of your school district taxes are now like refunded to you. And they're like, oh, that happened faster than we thought. Let's add community colleges and make it 30%. And let's have it expire never. Right? So as long as the state coffers are full, it is not set to expire. If there's ever a period where they're not collecting as much taxes, then the credit could be less and less, or even go to zero. But it is not currently set to expire at all.
2 years ago, when they started it, you got a tax credit. You didn't have to have your accountant figure all the other shit up like last year. And then they tried to get the legislature to pass it, but Ricketts did that, where the accountant had to figure all that up. They couldn't just give you a certain percent tax credit, and then it would be so simple. No, they had to make it complicated, where they could make the damn accountant make more money.
Oh yes, I was at that meeting. I was like, you need to add it to the tax return so I can get paid. I'm joking. I was actually quite literally at that meeting. I was like, Governor, sir, no offense, awesome idea. Can we just put this on the real estate tax rolls and the county treasurers can just take care of it and it's just be done? And they're like, no, people will see it and they will appreciate it. And literally none of my clients see it or appreciate it. They have no idea it came from the governor, right? So
Was at the meeting, they wouldn't change.
they were not going to change. No. But the nice thing is all the outside state interest groups who own all the real estate, like in Western Nebraska, don't even know about the credit, so they're just missing out on it. So forget you, Bill Gates. I mean, no offense if you like Bill Gates. Anyway, right, so like all the out-of-state preparers have no idea and they're not getting the credit, and then I look super smart, hooray, but really a huge waste of time for everybody, yeah. But it does exist, so let's go get that money. Yeah. Good. I think that's all I have. If you have questions or whatever, we can chat. Is this where we drink and have fun? Yeah.
I have how do I show if like replacing some doors at my house, or do they have to have an energy efficient sticker, or how does that work?
So the question is like, hey, I'm replacing some doors at my house. How do I know if it qualifies? So my answer to that is, there is a whole website that says, here's the efficiency rating of the window pane, here's the efficiency rating of the door. What I've found, Aaron, is typically, if it was made in 2021 or newer, they almost all qualify. But yes, it is supposed to have a certain energy rating in order to qualify for insulation, door, skylight, metal roof, windows, things of that nature. Furnace, AC.
So there's and again, is that just, it qualifies?
Typically, it's new, it has whatever efficiency rating, typically it qualifies. I don't want to get myself in trouble, but typically all the new stuff qualifies. But you're still in the lifetime limit in 2022, so don't pay for that thing till January 1st, when we reopen the annual limits of $1,200 per year. Okay? Question?
On a 1031 exchange, have you ever seen the IRS come back and watch the 45 days?
This is a really good question. Have I personally seen the IRS come back and view the 45-day rule so they saw there was a violation, they kicked out the exclusion? I personally have never seen it. There is a court case. It does exist. And it's why attorneys will tell you, you must work with me, we must identify, we must close, right? And I'm not against attorneys. They do a great job. They protect us when it comes to stuff like that. There is a fee for that service, of course. I have so rarely seen a 45-day rule kick out a 1031 exchange. I personally never have seen it. There is a court case. Yes. Good question. Yes.
With the 1031s, how long do you have to hold the property in order to 1031?
So the question is, how long do I have to hold the property to perfect it? The answer is super gray area. I tell my clients, please hold it at least 2 years. I think the real number is 365 days. I think the real number is, what was your intent? Right? What are you trying to do here? Trying to escape us? What are you doing here? Okay? It comes down to intent. I think 2 years wipes out any concern for intent. 1 year probably does enough. 1 year does a lot of damage. 2 years, it's like, nah, this was an exchange. This is legit. This is legit. Great question. Yeah?
One more question about the tax credit. What if I purchased a property that during negotiations, the first got replaced? Do I get to count that as my tax credit?
So did you bought the property and the property had energy efficient property?
Well, it got replaced prior to my taking ownership.
If you look at the literal law, I think it will follow receipts and payment.
Okay.
So I think it will go to the person who bought it before and replaced, even though it was maybe part of your negotiations.
Okay.
Yeah. Good question. Other thoughts? Yeah.
With those items, do you just bring all of that to your accountant to show them?
Yeah. So don't do the shoebox thing, right? That's the joke, but do provide a dollar amount. And like what I tell my clients is, like, do you have a receipt, like a legit receipt from a legit solar company that has the legit ratings? Like, let's make a photocopy of that. That's the evidence we need. I really just want to know the dollar amount, what you got. I think most accountants would appreciate if you just had like a one-page. Now, if you brought the packet and their sales slip and, no, don't give me that. The dollar amount and the one slip of paper for receipt for each item, that's okay. Yeah, I would want to see that. Yeah.
Can you double up on energy credits and a cost seg with, say you put solar on top of your commercial building. Can you double up and get solar credits and then get a cost seg on the solar panel?
I don't see why not. Yeah, it's because solar panels themselves are not building structure components, so they should be 15-year property. They might even be 5-year property. So you get to depreciate it out and you get the credit on that, for sure. Yes. 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 The question is that doubling up? Not really. No, I don't think that's really doubling up at all. Because you bought the thing that you're depreciating, and then you get the credit, which the government happens to allow for energy efficiency. Yeah, great question. Great question. But you do have to pay for that. I don't know, whatever the solar panels are going for these days. Yeah.
Last question. For that furnace situation, if I'm selling a house and my furnace that fails inspection and the buyer wants me to replace it, you're saying if I, the seller, have a receipt for that, I can take that?
Correct. The seller replaced the furnace, it's energy efficient before the actual closing transaction. That's your receipt, that's your expenses. Even though the inspection made you do it, you paid for it, your receipt, that's your credit.
And if I'm a buyer, then the opposite's true. maybe I take credit for that furnace and I replace it and I get that $1,200.
If you as a seller can negotiate to a buyer that they need to pay for a $12,000 furnace so they can get a $1,200 credit, I would I would negotiate that. But yes, that credit should be a part of the discussion.
And that's a
Yes,
credit, right?
that's a credit. That is coming right off your taxes. It's also non-refundable, so you have to owe taxes to actually see it. But yes, that's coming right off your taxes. Yes.
What are some good bookkeeping habits that your clients have that you wish more of your
My
investors have?
the clients who have the best bookkeeping habits of mine, can I start with real estate?
Yeah.
I'm gonna start with real estate, and we can expand if you want to. The clients that I do best with, what are their traits for bookkeeping that are best? They source it to somebody else. All of my clients suck at bookkeeping. Like they are the absolute 100% worst. So they source it to somebody else who knows what they're doing, who provides me a very clean document that says, here's profits and losses and balance sheets, right? So those are really good habits. For the rest, if you're unwilling or unable, or you have some skill in that area, what I find to be best, I will ask a client this very basic question. Does your account reconcile? Do you reconcile? And every one of them will say what?
No.
Yeah, I reconcile. Yeah. And I go, cool. What was your end of the year bank balance? December 31st. What was your bank balance in your real estate business account? According to the bank statements. Like $10,000. Oh, that's great. And what did we start the year at? $10,000. Oh, that's great news. Okay? Now show me your deposits. 100 grand. Now show me your expenses. 50 grand. That's a $50,000 difference, but you said your bank went from 10 to 10, which is a $0 difference. So we're missing 50 grand. And they're like, what do you mean? I go, what do you mean? Like, you obviously are not reconciled. Like, so if you're doing it in QuickBooks Online, I don't care what you use. QuickBooks Online, Excel, a piece of paper, let's write it on a napkin. I don't care. But does your beginning bank balance, all your deposits, minus all of your expenses, ending bank balance, dude, perfect. If you have no idea what I just said, outsource. Okay? The best traits are reconciling. And you need to be doing it monthly. Truly, every month. Okay? And then you throw in things like loan balances. And they go, what? Go, this says your loan balance was $400,000 at the end of the year. And they're like, I have $800,000 of loans. It's like, did you buy a house you didn't tell us about? They're like, I did. Right? So that's a problem. So first we get cash to reconcile, and then we get the loans to balance, and then we might be doing work. Okay?